Good morning, Van. How you doing? Thanks very much. Thank you, everybody, for joining us today on Bank Talk. It's Van and Ethan, and I think we've got a lot of things to talk about, and particularly in the second quarter earnings.
It's bank earnings season, Ethan.
Yes, it is. It's fun times, sir. Fun times. I look at this quarter as just a repeat in many respects of what we saw in the first quarter, just building on the same thing. We're getting some reasonable earnings growth, 2 to 3%-ish, getting higher pre-tax earnings, obviously because of the 21% tax cut. You now have a higher ROA number. It's still, it was interesting, a couple of the institutions that I saw are cautious about a lot of things that they read about. We all are talking about the tariffs, and I heard from a bank in Michigan who was talking about tariffs a bit. But, from what everybody's saying, it doesn't seem like a lot of this stuff that we're reading in the news are really filtering into earnings. Really what's filtering into earnings are loans are up a little bit, deposit cost pricing has not really changed dramatically, except for what people were expecting in terms of some shifting in the structure. But other than that, it's still pretty much good times.
It is. It reflects the economic environment, right? So we're in our 9th year, I think, if that's the right, of the economic expansion, the second longest in history, by all accounts, and by many market commentators and participants and economists believe that this is going to continue for some time now. So consumer confidence is at very high levels. Businesses seem to be feeling a bit more buoyant, and I think it's all sort of flowing through bank earnings, as you mentioned. One other thing you did mention, which is another very important thing, especially to credit investors, is that the credit environment remains relatively benign, right? So we had that subprime concern that came in markets back with some of the specialty finance companies and specialty banks back 12 to 18 months or so ago. We always thought that was part of the normalization of credit losses that will come out of the consumer side of things, but that seems to have settled down a bit, and of course on the commercial side of things, things are in very good shape. One thing that's interesting, and I think there's some debate out there.
Well, for some of the banks I saw, some of the net charge-off numbers in cards were up. They were up like 20, 30 basis points. Maybe that's just noise. I mean, I don't tend to look at that much, but it seems to me that there was a little bit of a year-to-year slightly higher.
I think that's the normalization, right? We get into this issue, we've always sort of watched for trends, right? But I think by all accounts, loan losses were unusually low going back the last several years, and so this is a normalization. This is banks doing what they should do. I think they're broadening a bit their targeted customers on the consumer lending side, and obviously the yields on those products are easily going to accommodate a modest rise in losses. So this is very much, I think, a normalization of credit losses, and consumer lending remains a very, very profitable business. I want to talk about loan growth, because that is one thing that I think has caught some people by surprise, is that loan growth is fairly sluggish, especially for an economy that otherwise feels fairly good. Your thoughts about why loan growth has remained in sort of the low single-digit growth pattern?
Well, what the banks report is that customers are drawing down a little bit. They're seeing a little drawdown on their deposits still. I mean, I think that, there's a sequence of how loans grow in the economy, and typically first you've got to start drawing down on your checkable deposits. We'll talk about that in a second, because the graph I had in this month's chart deck I thought was kind of interesting to think about. But, I think it's just, there's also some uncertainty that the banks talk about still. I mean, there's the tariff issue, and just a general, where's the economy going, and this is the right time to build. I mean, we are 9th year, as you just mentioned, into a recovery, so typically you get a little bit more cautious around the end of cycles. Yeah, and maybe there's some structural things too that's changed.
I think some of this also might be that there is more competition in the lending business these days. The capital markets are at record sort of levels of issuance. The CLO bid is very, very strong, and direct lenders are now a very real force in the lending market. So the competition is high, and I think, so we shouldn't just look to relatively muted growth at the banks and wonder where all the credit is.
You see this as a credit issue for the industry as a whole?
I really don't. Where but let's think about it this way. So when we go out and see banks, we always look for banks that reach for earnings via the loan book, right? Now, all banks kind of reach for earnings via the loan book. That's how they make money. But for those,
It was the bond book.
it's not the bond book. You know that. So we do sort of look at banks that are growing at multiples of the rate of growth in the economy just to sort of test them for, is this healthy loan growth or not? And I'd say that for a lot of the banks that we talk to, I think they feel like they've got the capacity and the expertise to stay and find loan growth in their markets. Those that don't and start to do things differently, go out of market or start to be more aggressive in particular loan types, those are sort of red flags that we will investigate. So it can be a credit issue. At this point in this cycle, there's not a lot of concern.
Well, so another thing in the news this month is we'll talk about in the newsletter is the Fed releasing banks under 100 billion from the LCR and DFAST. I think this is going to be the interesting question for the rest of this year, and is the investor base then coming to banks that have been released under 100 billion and saying, okay, show us the excess capital. Where's this coming? Yeah. And these banks are on the calls. I mean, this was like, we're getting to it. We're getting to it. We got to think about some of these other investments that we still need to make. It doesn't feel like there's going to be that much capital return.
I really don't think so. Some of this is just the market discipline. I think it steers banks into a particular sort of level of capital ratio. It's not like the regulators have gone away, right? So even though the rules may have been relaxed a bit, I think that framework, the mindset, capital adequacy remains very much in place. So I really don't see that as being material to what's going to happen in the industry.
Well, I think it will be interesting to see as these institutions get pressed by their shareholders what they do with this capital, because at some point you're going to say, your capital ratios have been managed for the stress testing, and now you've been freed from stress testing. We've been long waiting for that. Because, you think about this. Here's something to worry about. Bank stocks have been bid up.
Yes.
They've been bid up on the idea that capital is coming back.
I don't know so much of that. I think it's been bid up on some of it is just the returns that will come out of tax reform. I think that was sort of part of it. I think consolidation is still a very real force, especially in a lot of the community and regional banking space that we see there. And let's be honest, right? Banks are making good returns these days, and if the economy is going to remain in expansion for the next couple of years, this is when bank stocks do get bid up.
Well, we will see. By the way, it all looks great, Van. But if you saw the IMF release that just came out just the other day, that was not such an optimistic view. They were looking at slower earnings, slower GDP growth globally. China, the yuan is falling off a cliff. Well, I don't know if it's falling off a cliff, but it's definitely declining here. There's a lot more pressures in the globe that, while things seem great here now, could, at some point that doesn't get disconnected. I don't know. I think it's definitely makes sense for a wariness on the part of the investors and part of banks and how they manage this risk at this stage. Something doesn't quite add up.
Well, I think the way I would look at it, I would agree with all of that. The geopolitical risk that we see around the world is very real, and it hasn't really diminished much over the last several years. It's kind of been there, and I think it is still there. This is a healthy economy. There's a lot of things where I think, especially in securities markets, valuations are stretched. And so I don't get a sense that the investors, whether you're an equity investor or a credit investor, feel all that comfortable with the future. So there is kind of a natural check against some of that exuberance, and maybe that in the long run is a healthy thing, especially for creditors.
Right. Well, one point to that, we have this new current expected credit loss rule, accounting rule that's coming up in 2020. There were a few comments on, basically to your point, all suggesting that that's a non-event. Now, it will be a non-event, assuming that we're not in the midst of a downturn in the credit cycle in a couple of years. And again, I'm willing to go on the other side of that bet for now, but we'll see. Just a couple of things in the chart deck that I put out I wanted to highlight. One was this graph I had that shows the growth in checkable deposits as a percentage of total deposits. That was pretty interesting, no? Don't you think?
It is. I would not have expected it, right? We're finally in the rising rate environment. You'd think that some of that money would move out of a no earning asset into accounts that actually pay something. So I would expect, and then as we talked earlier, maybe because of the expansion of the economy, those are the balances that typically get drawn down. See it go up the way it does. I'm not sure that I have an explanation for it. What do you think?
I think if you look at that graph I had, what's interesting is it goes through rate cycles.
Right.
So look, I would think checkable deposits is rate sensitive. What this graph is really showing is that, first off, there was a huge disintermediation of the industry up until the financial crisis. So the money market funds, the stock market, everything's siphoning off these deposits.
Right.
Post-financial crisis, that's actually changed. That mindset's changed. People want to sit with more liquid assets. And even now, 9 years after recovery, this is a tell. Now, again, this is a big, broad macro number I pulled off the St. Louis Fed data, but it's worthy of thinking that, hey, I would have expected this to be more rate sensitive. The graph is not rate sensitive. It tells you something that there's much more structural going on in the deposit story than you want to give.
I agree. Some of this might be inertia, right? We've been, treasurers, corporate treasurers have kept money in deposit accounts now for years, and yes, the rate rise is here. Eventually, that's going to get siphoned off to some degree, but there's still a fair amount of inertia in there. And I think your point in terms of the conservatism that's still there, the line of sight in this economy, despite being in its 9th year of expansion, has never been all that great, right? So I think there is a conservatism out there to continue to make sure you've got enough money for the rainy day that at some point is going to happen.
And then the last graph I thought was worth just highlighting here was this graph I had in the chart deck that talked about bank loans to manufacturing companies, that it doubled since 2013. That surprised me too, because you don't hear a lot of that going on. But I guess, as you pointed out earlier, we were talking about this before the call, it's still a relatively small number, so it can bounce around. It is noteworthy, I think, that short-term loans have declined relative to the proportion of total.
Yeah, so again, it's a relatively small number. I think it is subject to sort of bouncing around, but that does reflect that the economy still is in fairly healthy shape. And the death of the manufacturing sector, I think, in the U.S. has been long overestimated. So there is some vitality there. We're certainly seeing it in the more macro numbers, and it is showing up a little bit and driving a little bit of that bank loan growth that we do see.
And I know we've gone a little bit longer than we normally do on these, but I just wanted to mention this month's newsletter that's going to be out in the next week or so, called Bank Treasurers Embrace Mobile Banking. And one of the points I find fascinating that they were talking about is the capacity of institutions, the larger banks particularly, but I think this is a business prop for many institutions, to be able to acquire deposit accounts relatively inexpensively without the branch presence or with much less of a branch presence. I mean, one person said, the only reason people really want branches is so that they can go in and yell when something doesn't go right. And I think about that. Okay, that makes some sense.
No, there are different ways to skin a cat. I think there are very successful digital strategies that are almost an essential offering for a successful bank today. And yet, I literally met with a bank yesterday that was a big proponent of the branch banking system. So I think it all comes back to sort of execution. And I've always thought that branches really are sort of billboards, right? It's a way for you to build local scale because if you're out in the market, you'll drive by a branch and say, oh, I keep seeing that bank, that bank, that bank. So it's a way of reinforcing sort of the brand, and I think that can be valuable. So I think, again, different ways to skin a cat. It's all about sort of execution.
But I think from a credit standpoint, you need to think about this more, is that it really changes the business prop of a core deposit. What is a core deposit? If you're capable, and millennials do this, more, which is not surprising, but even Gen X and boomers are doing this, they're getting to a point where switching my account on my iPhone or Android or whatever you're using to communicate, that smartphone, you could do it in the palm of your hand within minutes to switch a bank account. If that business prop changes and the cost of acquiring these deposits change, and a bank could offer the highest rate possible because it doesn't have no expenses, wow, that's got to change the whole thought process around when we think about liquidity and core deposit funding for institutions, what does that really mean?
Yeah, it's an enormous credit advantage, right, for the banking system, right, is to have deposit funding. I agree with you. One of the many joys of the internet is digital strategies is transparency, and that just means that better things for the customer. It means that change that dynamic a bit on the bank side. Let's not lose sight of the fact that for especially commercially oriented banks, those deposits are, I think, much less likely to sort of bounce around because those deposits are kept with banks for a reason, right? They can buy down rate, they can get a variety of services with those deposits. So those we do think are going to be or still remain quite sticky and quite valuable. But I agree with you on the margin.
Stable, but I don't know about sticky.
Well, I think it'll actually be sticky
because operational deposit funding has gone up.
No, but I'm talking about true commercial core deposits. They're there for a reason. They are going to be sticky because that's a relationship that company has with its local bank. I agree on the margin. You're going to start to see a lot more deposit movement because of technology. That's one of the things. That's one of the evolutionary steps of the business, and we'll watch over time to see how that impacts ultimately the value of those core deposits. Which are so important to the banking model.
Well, I know we've gone real long this time, Van, but this has been always a good bank talk. So till next time.
All right.
Thank you.